Hello, everyone. In this video, I'm going to wrap up chapter 2 and give you a short test review for chapters 1 and 2. So what I'd like to do is start out with a PowerPoint. Let me go ahead and share my screen. Here we go. Okay, we're going to start out with a little T account practice. Kate Brown recorded the following transactions in a general journal during the month of March. Post these entries to the cash account. Now, notice that our journal is our diary, and we really can't see what our cash balance is. We just have a series of transactions, but by posting the transactions into the ledger, we can see what the balance in our accounts are, specifically cash. So on March 1, we had a cash balance of 600. And on March 4, we received $2,280 in cash. So let's post that. Okay. And then on March 15, we paid cash of 400. Now that's a credit. So let's go ahead and put that in. And then on March 19, we paid another $92. That's a credit. So we'll put it here. Now, if we net everything, the money we received and the money we paid, our net cash balance is $23.88. It's interesting to note that when you net them, the side that has the bigger number, the debits or the credits, well, the side that has the bigger number wins. So here we've got a lot more debits than credits. So when we net them together, we have a debit balance. The debits win, right? But how did I get that 2388? 600 plus 2280 minus 400 minus 92, which gives us a net debit balance of 2,388. And that is our cash balance. Now, I said that if debits are greater than credits, the account will have a debit balance. So you can see here that we've got $18,000 of debits and we only have $3,000 credit. So what's our net balance? Well, it's going to be 15,000 debit. The debits win, right? There's 18,000 here on the debit side. There's only 3,000 on the credit side. You net them together, the 18,000 minus the 3,000, you get a balance of 15,000. Okay. Now, if the debits are less than credits, the account will have a credit balance. Well, here we have a debit balance of 10,000. On the credit side, we have a credit balance of 11,000. Well, 11,000 is bigger than 10,000. So the credits are bigger than the debits. The credits win. So what's the net balance? A credit balance of 1,000. How do I get that? 11,000, right? 3,000 plus 8,000 is 11,000 minus 10,000. And that balance is a credit balance because the credits are bigger. They win. Credit balance of $1,000. Now, we've already done this, exercise 2-19, so I'm going to go ahead and move on. This is what your book offers you as far as the 4 financial statements and the purposes. It's kind of wordy, and I'm just going to explain it to you, and then we're going to use our test review document to kind of boil this down into the essential elements. So let's just move on here. For an income statement, we know that the income statement shows revenues minus expenses equals net income. That's the form. Revenues minus expenses is net income. And we'll use the inner column for the detail. So it looks like we've got two revenue accounts, right? We add them up and then we go over here for the total revenue. Likewise, in expenses, we use the left column to list all of our expenses. And then we add them up. We have total expenses of $2,705. And what's my net income? Revenues minus expenses equals net income. Now, keep in mind that income statement shows revenues and expenses and reports net income. Also notice that it's for a period of time. In this case, it's for the month of December. So we're talking about net income that you earn from December 1 to December 31. If it said for the year ended December 31, that would be from January 1 to December 31. So whatever the period of time is, that's what you got to be know what you're reading, right? So you know what you're looking at. Okay, now see that net income? That's going to flow into our next statement, which is the statement of retained earnings. Now, again, the statement of retained earnings is for a period of time. Again, it's for the month of December. The form of the retained earnings statement, and we've memorized this before, is beginning retained earnings plus net income minus dividends is ending retained earnings. Okay, so what is the purpose of the statement of retained earnings? It's to show the change in retained earnings. It answers the question, well, how come on December 1 we had no retained earnings, zero? Well, it's because we just started our business, apparently. Well, then at the end of the month, we ended up with $3,195. Why did it go from zero to $3,195? Well, net income came in, but yet you distributed some of that net income in the form of cash dividends. And that's why you have an ending balance of retained earnings of $3,195. Now, that number is going to flow into our balance sheet. See, here's our the magic number there. We're going to put that into our balance sheet. Remember, the equity section is made up of common stock and retained earnings. And because we prepared our statement of retained earnings, we already know what the ending retained earnings is. So we're going to put that right there. Now, notice that on the balance sheet, it's for a point in time. It just has a date. It's the only one that won't say for the month ended December 31. It's just going to say December 31. Why? Because it's a snapshot. On December 31, I had this much cash. On December 31, I owed $6,200 to my vendors, that type of thing, right? Now, what's the form of the balance sheet? It's the accounting equation. Assets equals liabilities plus equity. And notice, you know that you're correct if your assets equals your total liabilities and equity, right? So that's how it kind of works. What I'd like to do is to get you guys to get your test review out, and we're going to fill it out a little bit here. So let me go and do this. And I think there it is. So pull your study guide out. I asked you to print it out. So hopefully you guys did. Remember, I don't want you just to be sitting on your bed in your pajamas, eating popcorn, watching me like you're watching a movie. I want you to be active. So right now, and we're going to finish all this later, but right now, because we just did our financial statements, this is it in a nutshell. Man, I tell you what, you know, that wordy PowerPoint slide had all those words that look really intense. I boiled it down into this. This is the way to go. I give you three parts. I define the financial statement. I say, is it a period of time or point in time? And then what's the form of it? Okay, so write this down. For the income statement, what's the definition? It lists revenues and expenses, and it determines net income. It lists revenues and expenses and determines net income. So is it for a period of time or for a point in time? It's for a period of time, right? It's for a period of time. So you'll see for the month ended December 31, or you'll see for the year ended December 31. And the only one that just has the date is the balance sheet, right? So you can keep that in mind. So this is going to be point in time. Anyway, what's the form? It's simple. Revenue minus expenses equals net income. Revenue minus expenses equals net income. The next one is our retained earnings statement. And the definition is this: it summarizes changes in retained earnings. The definition is it summarizes changes in retained earnings. Is it for a period of time or a point in time? It's for a period of time. Okay. What's the form? Well, this is the one I had you memorize. Beginning retained earnings plus net income minus dividends equals ending retained earnings. So it's the retained earnings statement summarizes changes in the retained earnings. Well, it shows, well, I started out with retained earnings of this, but at the end, I had this. So it summarizes the changes from beginning to the end. Why did it change? Well, we received some net income, but then we distributed some of that net income as dividends. And finally, we have the balance sheet. And what does that do? It reports financial position. It reports financial position. Now, is it a period of time or a point in time? It's a point in time. It's the only one that will just say December 31. It will never say for the month ended December 31. They'll just say December 31. On that day, my cash balance was this. On that day, I owe this much money to my vendors for accounts payable. Now, what is the form? It's easy to remember because the form of it is our accounting equation. Assets equals liabilities plus equity, right? Okay, what I'd like to do now is I'm going to go back to my slideshow. We have this thing called debt ratio. It's really easy to do and to calculate. It's just you take your total liabilities, divide it into your total assets. So you're basically comparing your total liabilities with total assets. And where are you going to find this information? Well, liabilities and assets are on your balance sheet. So you'll compute the debt ratio by looking at your balance sheet. Now, what does the debt ratio do? It evaluates the level of debt risk, right? So the more liabilities you have as compared to your assets means that it's more risk, right? A higher ratio indicates that there is a greater probability that a company will not be able to pay its debt in the future. You know, debt is like medicine. In the right amounts, it's good for you. But if you overdose on your medicine, you could die, right? Well, same thing. If you overdose on your debt and you won't be able to pay your debt off, then you die. Your company goes bankrupt and you're through. So this is why users of financial statements are interested in this debt ratio. How risky is it? Will they have enough money to pay their liabilities? Okay. So let's go ahead and work exercise 229 on page 73. So I'm going to go ahead and stop the share here. I mean, not stop the share, but stop the PowerPoint. And I'm going to go to this. Okay. So you have to get your book out on page 73, exercise 2-29. So it gives you this information, right? And you know the column, they have a column of expenses. That's smoke. You don't need that. You don't use it. Just disregard it. They're trying to trick you. Don't fall for it. All you need is your and you don't need net income either. What you need is total liabilities and total assets. That's the only thing you need. So let's go ahead and compute each of these. So DreamWorks has total liabilities of 30,000, assets of 40,000. So their debt ratio is 0.75. Look at Pixar. Wow. Liabilities are 147, assets are 150. So 147 divided by 150, that's pretty high, man. Your liabilities are almost equal to your assets. That's pretty risky, I would think. And then Universal, liabilities of 17,000 divided by assets of 68,000, it's 0.25. If you just wanted to look at this by itself, you would say that Universal is the less risky company. Their debt ratio is only 0.25. Pixar looks pretty leveraged, and that could be potentially a lot of problems. In all fairness, it's really interesting if you can use other people's money and make more money from it, then you do well. So going in debt and getting the bank loan and that type of thing is a good thing, but you better be able to make more money on the use of that creditor's, resource than you have to pay them. So many years ago, I was teaching at National University in the master's program, and I had my students do financial statement analysis. And one guy did Gottschalks, which was a local company, and I don't know if you remember them. They went bankrupt. Well, if you look at their balance sheet, they were highly leveraged. They had so much debt. Well, and basically they took all this money in debt, but they couldn't use the money to make more money than they had to pay back. They went under. I was shocked, though, when another student did Target, and Target was leveraged to the hilt too. I'm thinking, man, that's pretty risky. But the difference is, I don't know how they did it, but Target was actually making money off of their borrowed money. They're making more money, so they were making it work. But the potential is, if you borrow money and you're not making more money than you have to pay back, that's when you get in trouble. So anyway, that's the debt ratio. All right. I think at this time, let's see what we're going to do here. Yeah, that's going to conclude my lecture on chapter 2. Let's go ahead and talk about our test that we're going to be doing this coming week. So I'm going to go to the study guide. Okay, let's just start from the top. Now, you need to be able to answer these questions. And I guess I'll go through a couple of them. I'm not going to go through everything because, you can look it up. This is supposed to be a review and you're supposed to know this stuff. So, but what is accounting? Well, accounting is an information system, and it provides information to users. And who uses that data? Well, internal users and external users. A classic internal user would be the manager, right? Managers use that information to see how well they're managing, right? They're given resources, and then they're supposed to make a profit from that. And anyway, they'll use that data to see how well they're doing. Classical external users would include shareholders. I was telling you in my lecture before that I used to have Bank of America stock. Well, as a shareholder, I'm an owner, but I don't work inside the business. So I'm considered outside the business as an external user, but I'm still interested in the information because I want to know how well the company's doing. Another classic type of external user would be a bank. And when I was an auditor for Touche Ross in the day, my client would hire me and my company to audit their financial statements because the bank wanted to see those financial statements, but they wanted assurance that those statements were prepared in accordance with generally accepted accounting principles, GAAP. It gave the banks assurance that what they were seeing is something they can rely on, okay? Now, what is GAAP? Generally accepted accounting principles. And what organization is responsible for developing GAAP in the United States? It's the FASB, okay? So that's I think that's going to be the test question, but just be ready for it. Then I have these principles and assumptions that you need to know. Let's go ahead and go through this one, the cost principle. The cost principle just says that we are going to record our assets at what it cost us. Okay, so a test question could be like, okay, in 1930, your company bought this building for $50,000. It cost your company $50,000. Now, many decades later, that building is worth $50 million. Okay, it's worth $50 million. What are you going to carry that building on? The original cost of $50,000 or for what it's really worth, $5 million? Well, because of the cost principle, you are going to record it at its original cost. So even though it's worth like $50 million, you're going to keep it at its original cost of $50,000. And before, you may have that question, well, why? That's you're undervaluing your assets. Well, the going concern assumption states that you're not going to sell that building. You're going to keep using the building, so it's okay to use the cost principle. The revenue recognition principle just says that revenues are recognized when earned. It doesn't matter if you receive the cash or not. Expense recognition principle. All expenses must be matched against the revenue. Okay. What is the monetary unit assumption? Only transactions that can be expressed in money, in dollars and cents, can be recorded in a transaction. What is the business entity assumption? Well, each entity has to be separate from other entities. So, you have to have your own set of books. For like in GM, I was telling you, like Cadillac would have its own set of books. Chevrolet would have another set of books, right? Or if you were a sole proprietor, then you would have one checking account just for your business activity, and then one checking account for your personal activity, but you don't commingle them. What is the time period assumption? Well, it just means that we can break up the life of a business into a time period, and time periods could be a month, it could be a quarter, or it could be a year. And most of the time, you want to do it by month because you want your financial statements monthly because you want to know how you're doing each month. And know the difference between a proprietorship and partnership. Well, proprietorship is one owner and partnership is more than one owner. And know that they do not enjoy limited liability. So, if you get sued, if the business gets sued, not only can they go after your business assets, they can go after your personal assets. So they can go after your company building and they can go after your personal house. For that reason, people like to incorporate because they enjoy limited liability, right? And you can read all about that. What I'd like you to do is write this down. You need to know the basic accounting equation. Assets equals liabilities plus equity. And then you need to be able to rearrange the accounting equation to compute liabilities and stockholders' equity. So algebraically, you can do it. I just gave it to you here. If you want to solve for liability, it's going to be assets minus equity equals liability. Or if you're looking for equity, assets minus liabilities is equity. And that kind of makes sense. I really, emphasize that point about this one because, we know the equity is called net assets. It's net after you subtract liabilities from it, right? Because we know that of the assets, the liability people have claims on that assets, and what's left over is your claim, right? So sometimes we call equity net assets. Another thing interesting here is I expand the accounting equation, right? We know that assets equals liabilities plus equity. And we know that equity is made up of common stock and retained earnings, right? The equity is expanded to mean common stock and retained earnings. And then what is in retained earnings? Revenues minus expenses minus dividends. And remember that you can remember this by red. R, revenues. E, expenses. D, dividends. Okay. The next portion of our program is to define and give examples of basic accounts, and then tell me which financial statement does each of the accounts go on. IS, which is income statement. RES would be retained earnings statement. And then BS, it's all a bunch of BS, right? Now, balance sheet. Sorry. Gotta throw a little humor in. Okay, so let's write this down. And see, you can use this on the test, and it's going to be pretty cool. Assets, the definition, items owned. Example would be cash. AR, which is shorthand for accounts receivable, and equipment. And where do assets go? On the balance sheet. BS, balance sheet. Liabilities, what's the definition? Amounts owed. Now, remember, if you see the payable, you know it's a liability, or you see unearned, it's a liability. So AP is shorthand for accounts payable, right? NP is shorthand for notes payable, right? Accounts payable, notes payable. And the one that always got me as a student, because I was focusing on revenue, I said, hey, how can it be a liability? It says revenue right here. Should it be a revenue? No, focus in on the unearned part, right? Unearned revenue. So unearned, it's a liability. Liabilities go on the balance sheet. Common stock. What is that? That's stockholders' investment. If the owner invests $10,000 in the business, then the cash will go up, right? But also his ownership interest goes up through common stock. And there's no example here because common stock is common stock. So I didn't put anything here. It goes on the balance sheet again. Next, retained earnings. Now, retained earnings is undistributed profits. That's going to include all of the net incomes that haven't been distributed in dividends, right? So again, retained earnings is retained earnings. There's no example, so I leave that blank. Now, where will you find retained earnings? This is what kind of blows your mind, but there's a retained earnings statement where you'll see the retained earnings. And remember, the ending retained earnings is going to flow to the balance sheet. So this is the one account that you'll see in two places, both the retained earnings statement and the balance sheet. That's the only one that you will see in two places. How about dividends. Those are profits paid to stockholders. Now, profits paid to stockholders, any dividends are going to be distributed from retained earnings, right? So you're going to see the dividend account on the retained earnings statement. Sometimes students get confused and they'll say, oh, dividends must go on the income statement. No, the only thing that goes on the income statement is revenues and expenses. So dividends, distributions of profits, which come out of retained earnings, are put in the retained earnings statement. So just remember that. This is one that some students get confused on. Okay, we got 2 more to do. Revenue. Okay, that's amounts earned. Okay, so examples would be service revenue. You mow a guy's lawn and you earn some revenue. Or you have a savings account and you're earning interest. And what is interest? It's really rent on your money. The bank is paying you rent on the money we call interest. Okay, now revenues are found on the income statement. And finally, we have expenses. Those are expired costs. And you could also say that those expenses help generate the revenues. And I said earlier that, hey, if you find a business where you only have revenues but no expenses, I want to know about that. I want to know that scam. I want in on that scam because you're always going to have expenses. And expenses will be on the income statement. Okay. So let's keep moving on here. We've already done this. We did this earlier. That's good. And, I'm going to give you the solution to this. So these are the answers, but don't write them down. I want you to try to do it yourself because it's a test review. It's over the time where I'm supposed to teach it to you. By now, you should know it. And if you don't quite know it, struggle through it and it'll stick and you will know it for the test. Okay, so 19 and 20, just do that yourself and do this by yourself again. We did it in class, but do it again because I'm testing you to see, do you know it? So I've already gone over it. So you should be able to do this independently. And finally, if on the test, there's going to be some journalizing. And if you can do these entries independently, then you will be fine. If you can't do these independently, there's going to be trouble. So I'm not going to go through these because by now you need to know them. You've done your homework, you're studying for the test, you're getting ready. Do these. And if you don't get them, well, then that's good. This is your last chance to learn it before you get tested on it. So these are the answers, right? So do it and then check your answers with this, okay? Okay, that pretty much does it for me for the study guide. So I think I'm going to go ahead and stop the share. So I guess I will probably be posting an announcement about the test and give you more specifics about it. So for now, happy studying. See you next time. Bye-bye.